Now coming after balance sheet, coming to the statement of profit and loss. This is prepared on the basis of a format given under Schedule 3rd, Part 2 of the Companies Act 2013. Schedule 3rd, Part 2 of the Companies Act 2013. The specific format is given for preparing the statement of profit and loss. Here also, when we draw the column, we will draw the column for the two consecutive years. One is for the current year and one column is for the previous year, previous reporting period. So current reporting period and previous reporting period. Okay, so this is the format: statement of profit and loss. Statement of profit and loss for the year ended. Suppose the year ended is on 31st March 2020, then we will write 31st March 2020, and if it is 31st March 2019, then we will write as on for the year ended 31st March 2019. So format is particular. This is also prepared in vertical format. Statement of profit and loss is also prepared in company in vertical format. Okay, so particular, there is one column for particular, okay, both for income and expenses. Note number: current year means current reporting period, previous year reporting period, previous year reporting period. So current year and previous year figure. This figure will be in rupees, it may be in lakhs, it may be in thousand. Okay. Now first item is revenue from operation. First item is revenue from operation. So previous year and current year. Thereafter other revenue. Other revenue, we will write it over here, previous year and current year. Then do the total of these two, revenue from operation and other revenue. Then this total is called total revenue. Means 1 plus 2, 1 plus 2. Total of this called total revenue. This is under third. Total revenue will be, we will write it in the third sequence, number 3. First is revenue from operation, second is other revenue, third is total revenue. Then we have to do the total over here. Come to the expense. Fourth is expenses. Expenses in the same particular column, same area. Expenses: cost of material consumed, cost of material consumed, previous year, current year. Purchase of stock in trade, purchase of stock in trade. Change in inventories of finished goods, work in progress and stock in trade. Change in inventories of finished goods, work in progress and stock in trade. So first one is cost of material consumed. Next is purchase of stock in trade. Thereafter change in inventories, work in progress and stock in trade. Thereafter employee benefits expenses, employee benefits expenses. Thereafter finance cost, finance cost. Thereafter other expenses. Then we do the total expenses. Then we do the total expenses, total of these expenses. Then we do the total. Okay. Then we do the total expenses, both for the previous year and current reporting period. So total expense, this is total expense. Thereafter, this is total expenses. Okay, total expenses. Thereafter fifth number is profit before tax, means total revenue, this third one, minus fourth total is this one. Fourth total is means expenses, total expenses total is this. So third minus fourth indicate the profit before tax. Profit before tax. Is it clear? Means this total revenue minus total expenses. Total revenue is in sequence third and total expenses in sequence 4 is equal to profit before tax. This will indicate profit before tax, previous reporting period, current reporting period. Thereafter tax will be deducted. Will deduct the tax. Okay, so last one is profit after tax. This will come profit after tax, means this profit before tax, fifth number minus sixth is called, the figure will come, fifth minus sixth figure will come in the seventh, profit after tax. So statement of profit and loss is prepared by the company under Schedule 3rd Part 2 of the Companies Act 2013 in a specified format. The sequence will be same. You can't do the changes in this sequence. This sequence will be same. Cost of material, purchase of stock in trade, change in inventories of finished goods, work in progress and stock in trade, employee benefit cost, employee benefit expenses, finance cost and other cost. Okay, now come to first one by one we'll discuss about revenue from operation. This is the revenue from operation. Under this, revenue from operation means it is the revenue earned from business activities, main activities of the business. So under this revenue from operation, under this, these items will be taken into account. First one is revenue from sale of product or services. If it is a service industry, then service. Okay, and if it is a manufacturing of goods, then product. Revenue from sale of product, gross means gross sales, less return. Return means sales return. So less return. Okay. Another thing we will take into account, revenue from sale of service. Revenue from sale of service. So revenue from sale of product, gross, less return, sales return, and second, if it is a service industry, then revenue from services. Revenue from sale of services. Next is other revenue income, other operating revenue such as sale of scrap, other operating revenue which are related to operating incomes, that is sale of, it may be a sale of scrap. So these three will come under revenue from operation. These three, is it clear? These three will come under revenue from operation. So what are the things comes under the revenue from operation? Revenue from sale of goods. Revenue from the sale of goods means sale of product. Gross figure less return, then it's a net sales. If it is a service industry, then revenue from sale of services. Revenue from sale of services, net, because service is not returned, that's why it is a net. And third one is other operating revenue, if any, such as sale of scrap. So this is clear, other revenue. Okay, for finance company, if the company is finance company like banking, ICICI, IDBI, finance company, okay, IFCI, then revenue from operation, these items will be taken under revenue from operation if the company is finance company. So main income, revenue from operation for a finance company is interest income. dividend income, net gain or loss on sale of investment, net gain or loss on sale of investment, and revenue from financial services. So if it is a finance company, then revenue from operation will be taken on the basis of the nature of the company. So if the company is of finance company, then the revenue from operation under this, revenue from operation for a finance company, for ICICI, IFCI, IDVI, okay, for them, interest income, interest earned, okay, interest income, wherever the finance company has deposited money, and when they get the interest, then interest income, dividend income, when they invest the money some outside and they get the dividend income, net gain or loss on sale of investment, net gain or maybe the loss on sale of investment. And last one is revenue from any sort of financial services provided by the finance company to their customers and getting some amount, and in return they are getting some amount against their financial services. So revenue from financial services, these will come under the revenue from operation for finance company, if it is a finance company. And if it is a manufacturing company, then revenue from sale of product, gross less return. And if it is a service industry, then revenue from sale of services and other operating revenue such as sale of scrap. Is it clear? So under the revenue from operation, if it is a finance company, then this 4 will come, and if it is other company, then if it is a manufacturing of product, goods, then this will come, and if it is a service industry, then it is a service, revenue from sale of services. And operating income, operating revenue, any other operating revenue such as sale of scrap. Now other revenue, second one is other revenue. Other revenue means, other revenue is the revenue that is not earned from the business activities, main business activities. Other revenue is that revenue which is not earned from the main business activities, main operating activities. Okay, that is not the main business of the company. And if such revenue is earned, that comes under the other revenue. Okay, other revenue. So other income, other revenue under it, other revenue is the revenue that is not earned from the business activities. Other revenue means other revenue is the revenue that is not earned from the business activities, main business activities for which the company is established. If any such income is earned by the company which are not directly related to business, for instance, interest income, interest received or accrued, dividend received or dividend income, gain on sale of investment, if there is a loss, then less loss on sale of investment will be adjusted with the gain on sale of investment. And if the loss is still there, net loss on sale of investment, then that will be reflected over here in other expense. That will be reflected in other expenses if there is a net loss on sale of investment. So gain on sale of investment less if there is a loss on sale of investment, will be deducted from the gain on sale of investment. If resultant is plus, then that will be reflected in the other revenue. But if our sale of income, sale of or profit on sale of profit or gain on sale of investment is less and loss on sale of investment is more, then in case of net loss on sale of investment, that will be reflected in the statement of PL in this heading, subheading other expenses. Other expenses. This will be shown in the other expenses. So in other revenue, interest income, whether it is received or receivable, means accrued, dividend income, gain on sale of investment, less loss on sale of investment. If gain is more, then it will be reflected in the other revenue, and if loss on sale of investment is more than the gain on sale of investment, then that loss will be separately shown in the other expenses under this here, other expenses. And other incomes are also taken into the other revenue, other incomes. What are the other income? Rent received, dividend, discount received, commission received, profit on sale of fixed assets, sale of miscellaneous items, sale of miscellaneous item, refund of income. Miscellaneous item means scrap. Sale of miscellaneous item means old newspaper is sold. So sale of miscellaneous item and refund of income tax. So these will be taken into account for in the heading other revenue. So what are the other revenue? Other revenue is that revenue which is not earned from the business activities. That is not earned from the business activities. So what are those revenue? Revenue means interest income, whether it is received or accrued, dividend income, commissions, rent, discount, gain on sale of investment. Okay, and if there is a loss on sale of investment, then that will be adjusted from the gain on sale of investment, and even that the loss is more than gain on sale of investment, then that loss, net loss on sale of investment, will be shown under here, other expenses. So interest income, dividend income, gain on sale of investment, other income, rent received, discount received, commission received, profit on sale of fixed assets, okay, sale of miscellaneous item, and refund of income tax. Now thereafter we do the total revenue from operation and other revenue, then the resultant will be total revenue. Now come to the expense, cost of material consumed. Cost of material consumed. So what cost of material consumed means cost of raw material and other material consumed in the manufacturing of goods. Cost of material or other material consumed in the manufacturing of goods, manufacturing of the finished product. So cost of material and other material consumed in the manufacturing of goods. Under that, cost of material consumed, this will come material, raw material and other material which are consumed in the manufacturing of goods. Okay, so cost of material consumed, there is a formula. Cost of material consumed, opening inventory of raw material plus purchase of raw material minus closing inventory of raw material. So cost of material consumed is equal to opening inventory of raw material plus purchase of raw material minus closing stock of raw material, closing inventory of raw material. So this is the formula of calculating cost of material consumed. So opening inventory of material plus purchase of inventory. Purchase of inventory means purchase of material, purchase of raw material minus closing inventory of materials. Now one important thing is what? The spare parts stores fuel. If it is not the part of the raw material, it is not the part of the finished product, it is not used in the production as a finished product, then this will not be under the cost of material consumed. So materials such as stores, fuel, spare parts, etc., which do not enter into composition of finished product, which do not enter into the composition of finished product or finished goods, are excluded from raw material. These are not the part of raw material. What are spare parts? Okay, fuel, stores, which do not enter into the composition of the finished product, are excluded. They have to exclude from the raw material. When I am taking raw material over here, I am not going to take this raw material, spare parts, fuel and this. These will be shown under these expenses, other expenses. So stores, spare parts, this will be, or fuel will be shown where? In the other expenses. This is not the part of cost of material consumed. This will not be the part of cost of material consumed if they do not enter into the composition of finished product. They do not enter into the composition of finished product. Is it clear? It is not a composition of the finished product. Then that will be shown here in the other expenses. So cost of material is clear. Cost of material consumed means raw material and other material which are used or consumed in the manufacturing of finished product, of finished goods. Cost of material is equal to opening inventory of raw material plus purchase of raw material minus closing inventory of raw material. Come to the next is purchase of stock in trade. Purchase of stock in trade. Stock in trade means goods purchased for selling. Sell it again. Goods purchased for sell it again. There is no processing, no further development of the product. Just purchase and sell it again. This is the intention of purchase, is what? To resell it again. So purchase of stock in trade, under this it means what? It means purchase of stock, purchase of goods for resale. Reselling means resell it again. Okay, and next one is change in inventories of finished goods, work in progress and stock in trade. Okay, next is change in inventories of finished goods, work in progress and stock in trade. So change in inventory of finished goods, work in progress and stock in trade means what? Opening inventory of finished goods less closing inventory of finished goods. Similarly, opening inventory of work in progress less closing inventory of work in progress. Similarly, opening inventory of stock in trade less closing inventory of stock in trade. So it may opening inventory of finished goods less closing inventory of finished goods. Is it clear? So this resultant may be minus or may be plus. Opening inventory of work in progress less closing inventory of work in progress. Opening inventory of stock in trade less closing inventory of stock in trade. When we do the addition of these three, means A plus B plus C, total A plus B plus C. So this resultant, any of the resultant may be positive, may be negative, may be positive or may be negative. Okay. So purchase of stock in trade means when the goods are purchased for sell it again, that will come. If any stock is purchased and thereafter this will be processed as a raw material or modified before selling, then this will not come under the purchase of stock in trade. This will come under the cost of material consumed. Okay. Now next is employee benefit expenses. Any benefits which is given by the company to the employees. It may be a salary, it may be a wages, it may be a bonus, leave encashment, okay, medical expenses, electricity bills, whatever it may be, telephone charges, telephone expenses, medical expenses, transportation expenses, whatever the expenses the company bear for their employee, that comes under the employee benefits expenses. It may be a gratuity, contribution to the employee provident fund, employee stock option plan. So employee benefit expenses are related to the employee of the company which is given by the company, like wages, salary, bonus, leave encashment. Okay, wages, salary, bonus, leave encashment, contribution to the employee provident fund and gratuity, and other fund like gratuity fund and superannuation fund. Then staff welfare expenses such as canteen expenses, medical expenses, expenses on employee stock option scheme, ESOS, employees expense on employee stock option scheme. And next is employee stock purchase plan. After employee benefit expenses, next is finance cost. Finance cost means when we take the borrowed capital from the market, we pay the interest on that borrowed capital. We pay the interest or commission on that. So finance cost includes interest expenses and second, other borrowing cost. In finance expenses include interest cost plus other borrowing cost. So interest expenses such as interest on term loan from the bank. If you have taken any term loan from the bank, then we have to pay the interest to the bank. Interest on overdraft, interest on cash credit, interest on debenture, interest on public deposits, interest on bonds. ठीक है? So interest on term loan, interest on overdraft, interest on cash credit, interest on debenture, interest on public deposits, interest on bonds, and other borrowing cost is also included. What are other borrowing cost? Other borrowing cost means discount or loss on issue of debenture written off. Discount or loss of issue of debenture written off. This is also comes under the finance cost. Under the finance cost, if discount or loss on issue of debenture is going to write off, is written off. Similarly, premium payable on debenture, premium payable on redemption of debenture written off, premium payable on redemption of debenture written off. Next is loan processing charges. We know that to process the loan, certain charges has to be paid. So that will come under the finance cost, loan processing charges. Next is guarantee charges. This also comes under the finance cost. Comes under the borrowing cost, and borrowing cost comes under the finance cost. Commitment charges. Then commission paid for deposit mobilizations. Commission paid for deposits mobilization, to mobilize the deposit by the public. When we mobilize it and we pay the commission to the broker, then that also comes under the finance cost. Commission paid for deposit mobilization. So under the finance cost, these two things are come: interest expenses and other processing borrowing cost, another borrowing cost. These two, okay, interest expense and other borrowing cost. Interest expense, interest on term loan taken by the company from the bank, interest on overdraft, interest on cash credit, interest on debenture, interest on bonds, interest on public deposits, okay. And other borrowing costs: discount or loss on issue of debenture written off, premium payable on redemption of preference shares written off or debentures written off, loan processing charges, guarantee charges, commitment charges, and commission paid for deposit mobilization. To mobilize the deposit, we pay the commission to the broker. That also comes under the finance cost. So after the finance cost, the next item in the expense line is depreciation and amortization. Depreciation means when we are charging depreciation on tangible assets, tangible fixed assets, then it is called depreciation. When the tangible fixed assets is written off during its life or during its lifetime, when the tangible assets is write off, then it is called depreciation. And when intangible fixed assets is written off, then it is called amortizations. When it is intangible fixed assets is written off, then it is called amortization. For instance, writing off patents written off, copyrights written off, okay, goodwill written off, computer software written off. So depreciation and amortization, the two things are here. Depreciation and second is amortization. Depreciation and second amortization. Depreciation means when the cost of tangible assets, for instance land and building, plant and machinery, motor vehicles, these are written off, then depreciation. Amortization means when the cost of intangible assets is written off. Cost of intangible assets, intangible. Here cost of tangible and here cost of intangible. Intangible assets such as goodwill written off, patents written off, computer software written off, copyright written off. Is it clear? Then it is amortization word is used. So when depreciation and amortization is the next line item after the finance cost, thereafter other expenses. Now come to the other expenses. In other expenses, all such expenses will come which do not come under any of these expenses. If any such expenses which do not come under any of the line item, that will come under the other expenses. Okay, so that do not come under any of the line item of these expenses, right from cost of material till the depreciation and amortization, that will come under the other expenses. So examples are other expenses. Examples are carriage inward, carriage outward. If it is carriage inward or carriage outward. Freight, manufacturing expenses, rates and taxes. Insurance, less prepaid if any. Discount allowed, commission allowed, bad debts written off, and provision for bad and doubtful debts. Repairs to machinery, building and any other fixed assets. Trade expenses, administrations, expense on administration, office, telephone expenses, bank charges, loss on sale of fixed assets, directors fees, audit fees, Auditor's fees means audit fees, conveyance expenses, traveling expenses, courier expenses, telephone expenses, internet expenses, entertainment expenses, share issue expense, written off, or underwriting commission which is given at the time of issue of share if it is written off. These all will come under the other expenses. Is it clear? These all come under the other expenses. So we'll do the total of these right from cost of material to other expenses. This is the total expenses, and these total expenses when compared with the total revenue. So third minus fourth, then profit before tax, then tax will be deducted, then thereafter profit after tax, fifth minus this profit before tax minus tax is the sixth item, then you will get the profit after tax. Is it clear? Profit after tax. Now we will see one question and we will identify that this particular item will be under which heading. So question is, under which line item major head of the statement of profit and loss of a company will be shown? So the items are sales, interest on public deposit, wages, entertainment expenses, interest earned, sale of scrap, purchase of stock in trade, interest on term loan. So first is sale. Sale comes under the revenue from operation. Revenue from operation. This is the major head. Revenue from operation. Okay, sale comes under the revenue from operations. Then interest on public deposits. This interest is the finance cost. This comes under the finance cost. Thereafter come wages. Wages comes under the employee benefit expenses. Employees benefit expenses. Is it clear? Employee benefit expenses. Then entertainment expenses comes under the other expenses. Other expenses. Interest earned comes under the other income. It is not coming under the revenue income, it comes under the other income. Sale of scrap from revenue from operation. Revenue from operation. Okay, revenue from operation. Purchase of stock in trade. This will come under the purchase of stock in trade. It's a separate line item. Purchase of stock in trade is a separate line item. Stock in trade. Purchase of stock in trade. Interest on term loan comes under the finance cost. Comes under which cost? It comes under the finance cost. So items are this and major heads is this. I am giving you some item, you recognize that or you identified this particular item will be shown under which heading. Okay. Items are bonus, revenue from services rendered, internet expenses, material purchased, discount on issue of debenture written off, goodwill written off, gratuity paid, contribution to superannuation fund, patents written off, interest on debenture, profit on sale of investment, and audit fees. These are the items you have to identify that this item will be under which head, under which major heads. So we'll write the major head against this item. So first one is what? Bonus. So bonus comes under, bonus is given to employee, it is comes under employee benefits, employees benefit expenses, benefit, employee benefit expenses, है ना, employee benefit expenses, it comes under employee benefit expenses. Next is revenue from operations, revenue from services rendered. This will come from the revenue from operation under the head revenue from operation. Is it clear? Revenue from operation is the main business. Revenue from services rendered by the company. Internet expenses. Internet expenses comes under the other expenses. Internet expenses comes under the other expenses. Comes under other expenses. Okay. Next is material purchased. Material purchase comes under the cost of material purchase. Cost of material. Material. Cost of material consumed. It comes under cost of material consumed. Opening stock of material plus purchase of material less closing stock of raw material. Discount on issue of debenture written off. This comes under the finance cost. This comes under finance cost. Goodwill written off. Goodwill written off comes under the depreciation and amortization. Depreciation and amortization and amortization. Okay, depreciation and amortization. Gratuity comes under the employee benefit expenses. Employees benefit expenses. Benefits expenses. Contribution to superannuation fund is also comes under the employee benefits expenses. Employees benefit expenses. Benefit expenses. Contribution to superannuation fund or employee provident fund or gratuity, whatever it may be. Patents written off comes under the depreciation and amortization. Depreciation and amortization and amortization. Depreciation and amortization. Patents written off comes under the depreciation and amortization. Next is interest on debenture. Interest on debenture comes under the finance cost. It comes under which cost? It comes under finance costs. Next is profit on sale of investment. Profit on sale of investment, okay, comes under the profit on sale of investment. Revenue from operation. Revenue from operation. Profit on sale of investments. Revenue from operations. Next is audit fees. Audit fees comes under the other expenses. Comes under other expenses. Comes under other expenses. So these are the item and these are the major heads. Is it clear? These are the item and these are the major heads. So profit on sale of investment comes under the revenue from operation. If it is a finance company, if it is a finance company, and if it is not the finance company, then this will come under the other revenue. This will come under the other, okay, this will come under the other income. Other income. other income. This will come under the revenue from operation, profit from sale of investment when it's a finance company. Otherwise, if it is a non-finance company, then the same item will come under the other income. Is it clear? Same item will come under the other income for non-finance company.